Welcome back to the channel. Today we're breaking down a bold call from Dan Ives, Global Head of Tech Research at Wedbush. In his words, Tesla will be the best AI play in the next few years. Not just an EV story, an AI platform story. I'm going to play you his CNBC clip, then I'll jump back in with my reaction, what I agree with, what I'm skeptical about, and how this could reshape the Tesla thesis around autonomy, software margins, and robotics. And because I always turn big headlines into an actual game plan, stick around after my breakdown. I'll walk you through 2 top AI stocks I believe investors should have on their radar right now, and exactly why. If you only watch one video today, make it this one, and watch it to the end so you don't miss the actionable takeaways. Smash the like button, let's hit 1,000 likes, share this with a fellow investor, and drop your thoughts in the comments. If you're new here, subscribe so you don't miss the next crucial investing update. Alright, let's roll the Dan Ives clip, and then I'll tell you what it really means for your portfolio.
Why do you love Tesla so much?
Look, I mean, to me, look, the main thing is, my view is on the autonomous and robotics side. I mean, I think this now, when it comes to, it's going to be one of the best AI plays over the next few years. That's why we think it's going to be a $3 trillion market cap. But if you look at the demand's turned around. I mean, this is a bounce back quarter that shows, still more work to do. But this is now setting up for what I believe is going to be a historical 2026 because the AI revolution now comes Tesla.
Well, it better, because the lead of the show with Dan Ives,
that was great.
You're Dan Ives, by the way. He's Dan Ives. Was that every small cap stock in America combined is still smaller than NVIDIA. Mm-hmm. The same is basically true with cars. Every major car company in the world combined, can leave a couple out, are the same size or smaller than Tesla. Does that worry you at all?
Look, I mean, I was just in Detroit, and I think, you're definitely seeing some turnaround in GM and maybe, even Ford, but...
Yeah, on big SUVs.
But exactly. But
by the way, gas guzzlers.
But the reality is that Tesla is not an auto company. I mean, I don't view Tesla as a car company. I think Tesla is truly a disruptive technology AI play. When I think about, because the future is ultimately autonomous. I mean, when I think about autonomous and robo-taxis and what's going to ultimately happen in 30 to 35 cities in next year, that is $1 trillion alone from a valuation perspective in terms of a physical AI play. So that's why I think it's an apples to oranges what Tesla's doing in the rest of the auto sector. They're trying to play catch up.
Connect the dots, okay? I get the autonomous. I'm on the turnpike. I know where you live. You know where I live. I'm on the turnpike all the time. It's like demolition derby at this point. Cars are just going off in the woods. Everybody's on their phone. Half the people are stoned. I have no idea what's going on. I wish everybody had an autonomous car. I'm just going to look in the camera and say that. But we're because then we'd all just kind of cruise along the same way. We're a long way from that, Dan. A long way. How do we get there?
Well, first off, when you look at Tesla, I mean, today, let's call it 15% have full self-drive in terms of FSD. We think that's going to go to 50% over the next few years. So from a margin perspective, from a software perspective, that's going to be a game changer alone as that happens over the next few years. But in terms of autonomous, I mean, it's our view, 80% of autonomous world is going to be Tesla in terms of globally. So when you look over the next few years, you're talking about, let's say, 2 million vehicles, 3. We're talking about, like, eventually you'll begin at 4, 5, 6, 7 million vehicles. I could argue when that doesn't even include robotics in terms of Optimus, that that together could be more than the value of the company today. So that's our view. What's happening in this Tesla story is that the AI revolution, especially now with Musk back to being a wartime CEO. I mean, I think front and center. That's why we think $600 is probably conservative.
I don't know about I'm the car guy, and I can tell you that what Tesla has done, and I've owned EVs, I've driven a lot of them. What they realized is weight is the enemy. Keep the car light, and you can get more range, because if you do Ricardo Montalban said, the fine Corinthian leather. The way that we've been sold luxury now, cars are heavy, weight is the enemy of range. I think that's why Tesla is winning against many other companies. Does this also go to your very bullish view and possible M&A target of Lyft?
Mm-hmm. I mean, we put out our M&A target. I mean, I believe Lyft in the next 6 to 9 months is ultimately acquired as a top acquisition candidate, because it's the view of autonomous. It's a view, whether it's a strategic, whether it's a financial buyer. Lyft is one. If you combine that with an autonomous play, I think that's the future. I mean, that speaks to really this convergence that we're seeing in tech, autos, and you could say energy and some other sectors.
Where do they fit, though? You got Uber. Uber just seems to get all the attention.
Sure.
It also seems to get all the rides. I know it's not, being tongue-in-cheek. Rode in a Waymo, by the way, out in Los Angeles a couple times. That was pretty cool. It was a little weird at first, but then when you get used to it, you're like, oh, there's no driver. I don't know if that's was good or bad. Remember, somebody is probably always listening regardless. Where does Lyft fit in?
Well, I think, look, the issue with Lyft is that obviously when it came to food delivery, mobility, and also being only a domestic player, but you look at what they have from a rideshare perspective in terms of that, in terms of that network. If you combine that with ultimately autonomous technology, that I think is how maybe on the strategic side, PE is going to look at names like Lyft. And look, we just think this is going to be a tidal wave of M&A that happens in tech. Because with the AI revolution, still we think bottom of the second inning, you are going to continue to see this bull market play out. And that means strategic and financial buyers are going to be aggressive.
What you just watched is a very clear bull case that reframes Tesla less as a car company and more as an AI platform where the car is simply the hardware endpoint. Dan anchors everything on autonomy, software margins, and robotics. In his view, this isn't about selling more Model Ys. It's about turning a fleet into a software monetized network and eventually a robo-taxi infrastructure layered on top. That's the lens you need to keep in mind for the rest of his comments. When he talks about loving Tesla, he barely touches traditional auto metrics. No long detour on gross margins by trim or typical unit economics. He goes straight to autonomous and robotics as the core thesis and calls Tesla one of the best AI plays of the next few years. That's why he's comfortable talking about a multi-trillion market cap scenario. He's not valuing doors and wheels, he's valuing software penetration, network effects, and optionality from new product lines like Optimus. If you're still evaluating Tesla on ASP and quarterly delivery beats alone, you're grading the wrong exam. He also calls this quarter a bounce back and frames it as setup for a historical 2026, where the AI revolution meets Tesla's product roadmap. Read between the lines. He's saying the story now pivots from cyclic EV demand back to structural software adoption. The specific lever he highlights is full self-driving take rate. He estimates roughly 15% of the fleet has FSD today and sees that climbing to 50% over the next few years. If anything close to that happens, the unit economics change meaningfully because software attach drives high-margin revenue per vehicle without building a single new factory. That's the game changer he's pointing to. And yes, it would cushion gross margins even in a pricing war. Now let's talk about the big swing. Robo-taxis. He floats 30-35 cities next year and suggests the autonomous opportunity could be worth about $1 trillion in valuation on its own. The spirit of his point is important, even if you disagree on the pace. A functioning autonomous network flips the value stack. Transportation becomes a service Tesla sells and orchestrates, not just a product it ships. The equity market pays a premium for networks with recurring revenue and high switching costs. That's the dream scenario behind his apples to oranges comparison with legacy autos. While traditional OEMs optimize model cycles, Tesla pushes a software flywheel to the entire installed base. He also drops a line that will resonate with longtime shareholders. Musk back to wartime CEO. That's basically code for focus, urgency, and ruthless execution. When Tesla's in wartime mode, they cut prices to gain share, push features faster, iterate hardware, and flex vertical integration. If you believe that mode is back and sustained, you can see why he says a $600 price target might be conservative. That's not guidance. It's a way of saying the optionality is being mispriced if autonomy and robotics land. Let's balance the excitement with what it takes to get there. The host's reaction, we're a long way from that, captures the obvious reality. Autonomy at scale needs regulatory approval, city by city, robust safety data, bulletproof edge case handling, and consumer trust. Dan's counter is that FSD penetration itself, even before full autonomy, moves the financial needle. That's a fair point. Over-the-air improvements plus higher attach rates can improve software revenue well before a nationwide robo-taxi flip is switched. The risk is execution time. If FSD adoption stalls or regulators slow walk approvals, the market may not wait patiently. He also touches on Tesla as a weight-optimized engineering company, lighter cars, better range, contrasting that with legacy luxury that often equates heavy with premium. It's a nice reminder that even in a software story, Tesla's hardware-first discipline underpins the software edge. Efficient vehicles mean more real-world miles per kW, which means better data, which improves models, which loops back into better autonomy. Hardware and software are fused here. Now, the curveball in the interview is Lyft. He flags Lyft as a top M&A candidate over the next 6 to 9 months and ties that back to his autonomy theme. The logic is straightforward. A rideshare network plus autonomy tech equals a fast-track route to scale a driverless service. Lyft's downside has been its narrower footprint versus Uber and lack of food delivery, but it still owns a valuable demand network in U.S. mobility. Fold autonomy into that network via a strategic buyer or private equity catalyst, and you can see why he thinks we're staring at a coming tidal wave of M&A that blends tech, autos, and energy. He's framing Lyft not as a standalone growth story, but as infrastructure an acquirer might need to accelerate an autonomous rollout. Where does that leave Uber? The host notes, Uber gets the attention and the rides. Dan's answer is essentially, that's fine. Lyft can still be the right puzzle piece for the right buyer. If you're building a robo-taxi footprint and you don't want to start from zero, acquiring a rideshare network with demand and routing infrastructure can compress your timeline. Whether it's an automaker seeking distribution, a tech platform seeking mobility endpoints, or private equity seeking to re-platform with autonomy partners, Lyft's network is the asset. Again, timeline risk applies. Autonomy isn't a toggle, but it explains why he plants that M&A flag. Let's convert all of this into concrete things to watch if you're investing around these themes. First, FSD adoption. The North Star in his thesis is software attach moving from the mid-teens toward 50%. You want to see signals that the attach rate is actually climbing. Pricing experiments, subscription uptake, feature unlocks, and disclosure breadcrumbs in shareholder materials. If attach creeps up, you can model higher software ARPU and a richer margin mix. Second, autonomy milestones city by city. He calls out 30-35 cities next year. Whether you think that's aggressive or not, it gives you a checklist. Pilot approvals, operational safety stats, insurance frameworks, and early revenue per vehicle and service. Even a handful of cities that run robust, paid autonomous services would be a market-moving proof point. Third, robotics. He frames Optimus as a line of business that could be worth more than the company's current value. That's ultra bullish. For me, the realistic path is production-ready demonstrations outside controlled environments, early commercial tasks with measurable ROI, and disclosed unit costs that trend down. If Tesla starts landing credible pilot customers with repeatable workflows, that's when you move the robotics line in your model from optionality to scenario analysis. Fourth, M&A in mobility. If his Lyft view is right, you'll start to see positioning, unusual options activity, strategic partnerships that look like pre-M&A courtship, or PE interest around a platform, plus autonomy thesis. Any deal that stitches a rideshare network to a credible autonomy stack will tell you how the market is thinking about time to scale for robotaxis. Fifth, leadership cadence. Wartime CEO only matters if it shows up in ship dates, software releases, CapEx discipline where it counts, and ruthless prioritization. Watch the cadence of updates and whether promises slide or tighten. The market has a long memory for timelines in autonomy. Now, where do I personally net out on what he said? I think his framing is directionally right. If you view Tesla as an AI platform owner with a growing software annuity on top of a massive installed base, the valuation math changes dramatically. I also think his emphasis on FSD penetration is the most tangible near-term driver the market can track quarter by quarter. You don't need full robotaxis everywhere for the story to work. Where I tap the brakes is on the speed of city-scale autonomy and the trillion-dollar valuation jump purely from that in the immediate horizon. It's not that it can't happen, it's that turning technical wins into regulatory and commercial scale takes longer than any of us want. The key is progress you can measure. Attach rates, paid autonomous miles, and real-world robotics deployments. For Lyft, I think his rationale is sensible. A rideshare network is distribution, and distribution is leverage. If we start seeing credible autonomy operations in multiple cities, Lyft becomes a faster way to light up demand and routing. The risk is obvious. If autonomy timelines stretch, the strategic urgency to buy that distribution could cool. But in a world where bottom of the second inning for AI is true, the appetite for cut-and-paste acceleration via M&A is real. So if you're building a watch list or tightening a thesis after that interview, here's how I'd play it. Treat Tesla like a dual-track story. Hardware execution keeps the base healthy. Software attach is the upside lever. Use FSD adoption and autonomy city approvals as the scoreboard, not just quarterly deliveries. Keep optionality for Optimus in your model, but demand real commercial signals before you let it swing your valuation. And finally, in mobility, expect consolidation. If autonomy is the destination, owning pipes to customers, like Lyft's network, becomes strategic. Whether it's 6 months or later, that's the type of deal that can redraw the map. Bottom line, Dan Ives is saying the quiet part loud. This market is going to reward platforms that turn AI into recurring defensible cash flows. Tesla's aiming to be that platform in transportation, and maybe beyond. If they execute even halfway toward his vision, the multiple won't be driven by cars, it'll be driven by code. Now let's dive into the 2 top AI stocks to invest in now. The first company on our list is Coreweave, ticker CRWV, the powerhouse of AI compute. Coreweave offers specialized cloud compute power built for AI. Think of it as a cloud engineered for the most intense AI demands. Big AI models generate text, images, and code. They need lots of specialized chips called GPUs. Coreweave rents access to massive GPU clusters. It works with builders training the next generation of large models and supports companies deploying AI at scale for millions of users. This is not your average cloud provider. Coreweave chose a different path. Laser focus on AI workloads. That focus enables highly optimized systems for training and running AI. Specialization is its edge, attracting customers who need top performance. Like a race car needs a racing engine, AI teams need a specialized compute engine. Coreweave provides that engine. With access to the latest GPUs in large quantities, it draws top research labs and fast-growing startups. The business model is simple and powerful. Buy GPUs and networking, build efficient data centers, then rent access. Customers pay for time used, driving recurring revenue as AI demand scales. AI models need fast, dense computing power to function. Coreweave focuses on high-performance infrastructure, GPUs and the optimized networks connecting them. This sharp focus gives it a defensible niche in a massive cloud market. General clouds do many things well, but not always massive AI training best. Coreweave's architecture is built to excel at that one critical job. AI building splits into training and inference. Training feeds enormous data and requires immense sustained compute. Inference requires fast, responsive computing for real-time output. Coreweave lets customers scale up or down quickly for both. This flexibility is a necessity as teams iterate and deploy to growing user bases. Customers get faster training and more efficient deployments. Faster time to market. Coreweave can command premium pricing and stronger margins. Leading AI companies need tens of thousands of GPUs working seamlessly. Coreweave has proven it can deliver massive scale for demanding workloads. In a gold rush, the best picks and shovels can be very profitable. Coreweave is selling those tools to the AI world. A primary growth driver. Unrelenting demand for GPUs. AI models are getting bigger and more complex daily. Training requires exponential growth in compute, more GPU hours. As innovation continues, demand for Coreweave's core service grows. Partnerships and a diverse client base add recurring revenue and stability. Risk. High-end GPU supply is tight. Shortages can limit capacity and growth. Competition from large, well-funded clouds can pressure pricing and share. High-growth names can be priced for perfection. Any slowdown can hit the stock hard. Watch recurring usage growth. Land and expand is the key signal to track. Outcome. Powerful tailwinds. But investors must monitor supply, competition, and execution. If this is useful, tap like and share with someone who needs to see it. Now let's talk about the brains behind enterprise AI. Our second pick, Nebius, ticker NBIS. Nebius builds essential tools and services for companies to create, train, and operate AI models. If Coreweave provides the hardware, Nebius provides the software and platforms, plus expert services that make AI work in the real world. Think of Nebius as the OS and application layer for enterprise AI. It bridges raw tech and practical business solutions. Nebius's mission: democratize AI for businesses. Many companies want AI power but lack large specialist teams. Nebius provides tools that bridge the skills gap: software for managing models, tools for preparing and labeling data, platforms to integrate with existing systems, and operational support to keep everything running. As AI shifts from research to real-world use, Nebius becomes essential. It doesn't just sell software, it sells business transformation. That makes Nebius a compelling long-term story. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Level up your analysis with step-by-step lessons and practical strategies. Invest smarter with a framework you can trust. Back to the picks. A key Nebius growth driver: surging enterprise demand for custom AI. Industries from finance and healthcare to retail and manufacturing are using AI to boost efficiency, create new products, and gain an edge. Nebius is positioned to provide tailored platforms and services to make AI deployments succeed. As more large companies invest seriously in AI, the addressable market expands. That can drive significant revenue growth. Once apps and workflows are built on Nebius, switching is costly, data is integrated, teams are trained, models are tuned to the platform. High switching costs create a durable competitive advantage and recurring revenue. Risks: a crowded market of AI dev tools from both startups and large enterprise players. Nebius must innovate and execute flawlessly to stay ahead. Execution risk: enterprise-grade reliability, security, and performance are non-negotiable. Bugs, performance issues, or outages can damage reputation and churn major customers. Finally, the war for AI talent is fierce. Hiring and retention pressure costs and margins. Bottom line: sticky platforms and enterprise demand versus intense competition and execution risk. Coreweave and Nebius play complementary roles in the AI stack. Hardware compute: Coreweave is the foundation. Software platform: Nebius sits on top. Coreweave supplies the raw compute, the lifeblood of model training and inference. Nebius provides the tools and services that make that compute useful for business. Growth of one can help fuel the other. Example: a retailer training a recommendation engine. They buy GPU hours from Coreweave to train on years of data. They use Nebius to manage development, deploy, and monitor the model. Both companies earn from the same wave of AI adoption. Owning both offers diversified exposure across the AI value chain. If tools commoditize, compute demand can still be strong. If hardware gets more efficient, demand for sophisticated platforms can rise. Together, they can create a more balanced AI-focused portfolio. Before making any investment decision, it is always wise to run through a simple checklist. Do you truly understand each business model? For Coreweave, specialized cloud compute. For Nebius, enterprise AI software and services. Is revenue growing consistently at a healthy pace? Look for strong quarter-over-quarter and year-over-year growth. Are gross margins improving or stable? Can they fund growth without excessive debt? Does the valuation fit realistic growth? Avoid overpaying. Are you comfortable with the main risks? Short-term, these stocks can be volatile. Supply dynamics, earnings, and competition move prices. Day-to-day moves are often sentiment-driven. Long-term, if AI adoption compounds for 5 to 10 years, owners of key stack layers can grow significantly. This is foundational infrastructure, not a fleeting trend. Investors with a long horizon who ride out volatility may be rewarded. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments through any market. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Which of these two plays is more appealing to you? The raw AI compute power of Coreweave or the enterprise AI tools of Nebius? Tell us why one might be the better bet in the comments below. I'm always curious to hear your perspective. Don't forget to like, share your thoughts in the comments, and subscribe so you don't miss the next important financial investing update.